What happens when the last Bitcoin is mined?
Last one.
Last one.
This is arguably the most important question in crypto, and yet it's one that even die-hard Bitcoin bulls like Michael Saylor have had difficulty in answering. As the adoption of Bitcoin continues, this question will become exponentially more important because the existence of entire countries could depend on the answer if they start holding BTC as reserves. That's why today we're going to give you the most in-depth analysis you'll find about this important question, explain what the possible answers could be, and what it all means for BTC's price. My name is Guy, and if you hold Bitcoin or indeed any other cryptocurrency, this is a video you need to watch until the end. Alright, let's take it from the top so we're all on the same page. The Bitcoin blockchain is basically a distributed database consisting of blocks, with each block containing BTC transactions and a reference to the previous block. This begs the question of who creates these blocks of transactions and why they do it. The answer is Bitcoin miners, which are essentially specialized computers that expend computing power to earn the right to create a block of transactions. The reason why they do this is because each block contains BTC coins, which have value. Now, when Bitcoin launched in 2009, each block contained 50 BTC. Today, each block only contains 3.125 BTC. This is because every 4 years, the number of BTC contained in each block is cut in half in a process that's known as the halving. There have been 4 halvings so far. The first was in 2012, the second was in 2016, the third was in 2020, and the fourth 2024. These Bitcoin halvings will continue roughly every 4 years until 2140, when BTC's maximum supply of 21 million will be reached. As a fun fact, the reason why BTC's maximum supply is 21 million is believed to be because the value of the total global money supply was $21 trillion when BTC launched in 2009. If this was indeed the real reason why, then it implicitly assumes that one BTC will eventually be worth $1 million. More on that later, though. Now, the reason why these halvings exist is effectively to ensure that Bitcoin miners are incentivized to create blocks of transactions for as long as possible. By cutting the supply of newly issued BTC in half every 4 years, it practically guarantees BTC's price will double every 4 years, assuming, of course, that demand for BTC stays the same. And this is where things get interesting. The demand for BTC has not stayed the same. It has been steadily increasing, while the supply of newly issued BTC has been steadily decreasing. The result is that BTC's price has grown by a lot more than 2x every 4 years. In fact, it's grown by over 1 million x since 2009. So this begs the bigger question of what gives BTC value. Well, the short answer is that it's the only truly decentralized digital currency. Bitcoin makes it possible to store and transfer value digitally with the highest level of ownership guarantees relative to other digital currencies, including other cryptos. In other words, Bitcoin and the digital assets that exist on its blockchain, such as the BTC coin, cannot be controlled by anyone other than the person who holds these digital assets in their wallet. The fact of the matter is that nobody knows how much something like this is worth, hence why BTC's price is so volatile. That said, it could be argued that a digital currency that can't be controlled is increasingly valuable given the fact that governments are increasingly looking to control the flow of traditional currencies, which are mostly digital now. This can be seen in things like capital controls for citizens and sanctions for countries. Be that as it may, the most important thing in the context of mining is that the cost of creating a block of transactions is lower than the price of the BTC rewarded by each block. It's also important to note that the block reward doesn't just come from newly minted BTC. It also comes from BTC transaction fees. As another fun fact, Bitcoin technically doesn't have transaction fees. It has the option to tip miners to incentivize them to include your BTC transaction in the next block they're going to create. Because the use of Bitcoin has increased and the space in each block is limited, it is necessary to add a tip every time. Now, the answer you get when you ask Bitcoiners what will happen when the last BTC is mined is that Bitcoin will continue chugging along because the transaction fees will be enough to incentivize miners to keep adding new blocks with transactions because Bitcoin's use will keep increasing. This answer is somewhat questionable, though, given that these tips would need to be in the millions of dollars to sufficiently incentivize Bitcoin miners to continue supporting the blockchain in the future. Not only that, but it fundamentally makes a series of faulty assumptions about the dynamics of Bitcoin mining and BTC. And by the way, if you're enjoying the video so far, be sure to smash that like button to let us know, and subscribe to the channel and ping that notification bell so you don't miss the next one. But back to when the last Bitcoin, or rather the last BTC, will be mined. In case you missed it, the last BTC will be mined sometime in 2140. This fact gives the impression that Bitcoin will be fine until then. Believe it or not, Bitcoin could start facing issues as soon as the next decade, fewer than 10 years from now. That's because 99% of all BTC will have been mined by 2032, a fact that even Michael Saylor has underscored in interviews. At first glance, this suggests that Bitcoin transaction fees are going to need to rise quickly between now and then for Bitcoin to continue chugging along, and many have claimed this. Upon closer inspection, though, you realize that it's a bit more complicated than that. For starters, the cost of mining BTC changes depending on how much Bitcoin mining there is going on. If there's lots of Bitcoin mining, then the cost of mining will increase, and if there's less Bitcoin mining, the cost of mining will decrease. This is due to something called the difficulty adjustment, which exists to ensure that a new block is created every 10 minutes, regardless of the computing power committed to mining. Without the difficulty adjustment, the block time would change based on the total mining power, which wouldn't be good for BTC's economics. Given this fact, a surface analysis suggests that if the cost of mining BTC stays higher than BTC's price for too long, then there will be less Bitcoin mining. In turn, this will decrease the mining difficulty, which will lower the cost of mining, eventually making it profitable again. But again, it goes much deeper than this. If the difficulty of mining Bitcoin falls too much, then it theoretically becomes possible to do something called a 51% attack. This is where a single entity or mining operation gains enough computing power to control transactions on Bitcoin, which would be very bad given that its value comes from the absence of control. However, this assumes that Bitcoin miners are the ones who determine which transactions are valid. And this is where things get a little bit complicated, so listen closely. The Bitcoin blockchain is technically powered by two entities: Bitcoin miners, which process transactions, and Bitcoin nodes, which add and verify them. Now, once upon a time, Bitcoin miners were also nodes, meaning that if you were mining Bitcoin, you would need to run a node to do it. Today, not all nodes are Bitcoin miners. This is partially because Bitcoin mining is now done using specialized machines called ASICs, which can be linked together under one node, to put it plainly. It's also partially because lots of people run their own Bitcoin nodes, either for fun or to support the Bitcoin network in general. And this is where things get interesting again, because concerns that there would be a 51% attack on Bitcoin if its difficulty fell too low ultimately assume that most Bitcoin nodes would allow this to happen. This seems extremely unlikely, especially since Bitcoin nodes are easy to run. This actually by design. If a malicious miner tried to spin up malicious nodes to process their faulty BTC transactions, they would be outgunned by the rest of the Bitcoin community. Put differently, there would be an exponentially larger group of individuals and institutions who would be incentivized to spin up honest nodes to defend the blockchain. Something like this has actually happened once before, and you can learn more about the Bitcoin wars in the description. But back to those Bitcoin mining costs. The difficulty adjustment isn't the only thing that determines how much it costs to mine BTC. This is also determined by other factors unrelated to the Bitcoin blockchain, namely the cost of the hardware required to mine BTC and the energy required to power this hardware. Imagine a scenario where a Bitcoin miner has unlimited free energy because it uses some next-generation nuclear power source. Believe it or not, but this is already happening today, not with nuclear power per se, but with excess energy that's given away for free or energy that's being secretly stolen. Lots of Bitcoin miners already have operational costs that are close to zero. Even if the revenue from mining BTC were to decline, they would still be in the green and would therefore have no reason to stop mining so long as BTC continues to have value. The caveat is that it's unclear how many miners fit into this category. In sum then, Bitcoin is unlikely to collapse in 2032 when 99% of all BTC has been mined, and unlikely to collapse in 2140 when all BTC has been mined, because there are Bitcoin miners who will continue adding blocks of transactions to the chain so long as BTC has a non-zero value. But this also fundamentally assumes that Bitcoin will survive because of incentives related to mining, which may not be the case.
Hello, it's me, Guy's cousin Barry. I'm very sorry to be interrupting this no doubt fascinating video, but I want to tell you about the Coin Bureau deals page, so listen up and listen well. Alright, this is the place where you will find all the amazing promos and discounts what you, as Coin Bureau viewers, are entitled to. So don't be a mug, go and check it out using the link below. You'll find discounts on hardware wallets, you'll find exchange sign-up bonuses, some of which are absolutely bleeding mental, and you will find trading fee discounts there as well as a whole load of other goodies too. And let me tell you, old Barrington here, he's had to hammer the dog and bone all bleeding day and night to get you these promos and discounts. So you're welcome, thank you very much, go and have a look pronto, or I have to come and have a word. Alright?
And this is where things get even more interesting. As I mentioned earlier, Bitcoin's, or rather BTC's value, comes from the fact that it's the only digital asset that you can truly own, the only one that can't be controlled by a third party. Not surprisingly, this is something that's very valuable to sanctioned countries. The result is that we've seen many countries using cryptocurrencies like BTC for international trade, albeit to a limited extent so far. What is surprising, though, is the incentives these activities have created around the margins. As I mentioned a few moments ago, Bitcoin is operated by a network of miners and nodes. Logically, it's in the interest of countries using BTC for trade or holding BTC as reserves that the Bitcoin blockchain stays as neutral as possible. The only way they can ensure this is by starting up their own mining operations and spinning up their own Bitcoin nodes. Lo and behold, they seem to be doing exactly this. Take Russia, for example. It has reportedly legalized using crypto for international trade and could be mining its own BTC to that end. Iran has reportedly been doing the same for years, and it's even possible that China has as well, given that most Bitcoin mining reportedly continues to come from China. So then, if countries like Russia, Iran, and China are using BTC for international trade, do you think they care if they're mining BTC at a loss? Probably not. In fact, you could go as far as to say that they'd be incentivized to mine it regardless because an abundance of commodities in these countries makes the profit margins much larger. Never mind the dynamics around government-owned energy. Now, when you first hear about stuff like this, you might think it's kind of unsavory that these kinds of countries are using crypto, particularly when it comes to military financing, as is the case with North Korea. If you sit and think about it, though, you realize it is in fact paving the way for mass nation-state BTC adoption. Consider that Bitcoin followed the same adoption process at the individual level when it first started. Everyone knows that BTC's first real use case was to buy illicit stuff from the dark web. As unpleasant as that was, it nonetheless proved that BTC could be used as a medium of exchange, as was originally intended. Over the years, more and more people started using Bitcoin, and now we've got to a point where only a small fraction of BTC transactions are related to illicit activity, specifically 0.34% as of 2023. Newsflash, but we're in the early stages of the same thing happening with BTC transactions made by countries. Right now, most BTC transactions between and within countries are probably related to sanctions evasion. As time goes on, however, most BTC transactions between and within countries will be related to standard international trade. This will increase the incentives I mentioned a few moments ago. Specifically, it will result in even more countries starting Bitcoin mining operations and spinning up Bitcoin nodes to ensure that the Bitcoin blockchain remains as neutral as possible. Again, all the countries using BTC for trade or holding it as reserves will do this regardless of whether it's profitable. Come to think of it, it's even possible that Bitcoin adoption at the individual and institutional level becomes so widespread that people demand that their governments mine Bitcoin to keep it functional. This is admittedly a bit far-fetched, but it underscores how much the incentives around mining could change. And that reminds me, it's easy to forget that not all Bitcoin miners mine only BTC. On the contrary, it looks like most Bitcoin mining operations, including publicly traded mining companies, also mine other cryptos. Some of you might recall that Marathon Digital was recently mining Casper's Cascoin for extra revenue. Moreover, some of these Bitcoin mining companies can support their operations by taking on debt. If you think about it, borrowing money is analogous to shorting the currency being borrowed and going long whatever you're buying. Lo and behold, some Bitcoin miners have been taking on debt to buy BTC. When you remember that currencies are depreciating at a rapid rate, you realize that Bitcoin miners could theoretically support themselves indefinitely by borrowing fiat currency to mine BTC. So long as BTC's value keeps rising relative to the borrowed currency, Bitcoin miners can remain operational, all else being equal. When you pull up the chart of US dollars measured in BTC terms, you understand this fully. Now this brings me to the big question, and that's what all this means for BTC's price. Well, the answer isn't what you might think. In case it wasn't clear enough, it seems that the risk to Bitcoin isn't that the last BTC will be mined or that Bitcoin mining will become unprofitable. The actual risk is that Bitcoin doesn't gain enough adoption from individuals and/or institutions for new kinds of incentives to enter the equation. This explains why the Bitcoin community has been hyper-focused on adoption at not just the level of the citizen, but the level of the state. Getting countries to adopt Bitcoin will be good for BTC's price, but it's also arguably necessary for Bitcoin to survive in the long term, and it could be needed sooner than 2140. It's quite possible that Bitcoin needs to secure widespread nation-state adoption by the end of this decade to ensure that there are enough incentives to keep supporting its blockchain past the next halving. As you may know, the next Bitcoin halving is in 2028, and it's going to be brutal for BTC miners. That's just because the cost of mining BTC will double, all else being equal. With the cost of mining one BTC being between $70,000 and $90,000, depending on your source, this means that BTC's price would need to stay above $140,000 to $180,000 for most miners to stay profitable. Countries may need to start buying BTC for this to happen. But again, this assumes that all else will be equal. On the one hand, the possibility that lots of miners go offline after the next halving could reduce the cost of mining BTC due to the difficulty adjustment. I'll remind you that there are also lots of Bitcoin mining operations that have very low operating costs. On the other hand, though, it's possible that energy prices will start spiking by the end of the decade due to power demands coming from technologies like AI and the growth of the middle class in countries like India. Besides the fact that this could keep Bitcoin mining costs high even if difficulty declines, it could also result in government stepping in to stop Bitcoin mining so that energy can be used elsewhere. This has actually happened before, even in countries which presumably have a geopolitical interest in continuing to mine BTC. Take Russia, for instance. It recently banned crypto mining in regions facing energy shortages. Mining bans and pauses have happened in the US, EU, and elsewhere in recent years. From our perspective, the risk that energy prices will spike in the coming years and the risk that countries won't adopt Bitcoin fast enough are objectively bigger threats to Bitcoin than when the last BTC will be mined or when miners will have to start relying mostly on transaction fees for revenue. These risks are also less theoretical and much more immediate, which means they could have a bigger impact on BTC's price as a result. It wouldn't be far-fetched to say that a spike in energy prices and/or a lack of Bitcoin adoption by nation-states could mean that BTC collapses to zero by the end of the decade. On the flip side, however, low energy prices combined with rising nation-state adoption could make BTC as big as gold by market cap in the coming years. That's because Bitcoin's narrative is digital gold, and those advocating for nation-states to adopt Bitcoin have advised them to hold as much BTC as they do gold. I'm not sure if you've noticed, but the reason why gold's price has rallied so much in recent years is precisely because governments around the world are flocking to decentralized currencies that nobody can control and anyone can verify. This is literally what BTC is, and it's even better because it can be sent via the internet. To put things into perspective, gold has a market cap of roughly $18 trillion. And funnily enough, Bitcoin hitting a market cap of $18 trillion would translate to a BTC price of around $1 million when you factor in the inflation in fiat currencies we're likely to see in the coming years. It's almost like it was inevitable. Okay, if you found this video informative, be sure to smash that like button to let us know. If you want to stay informed about cryptocurrency, then subscribe to the channel and ping that notification bell. And if you want to inform others about what happens when the last BTC is mined, then be sure to share this video with them. What to watch next? Well, why not check out our video on the possibility of the US creating a strategic Bitcoin reserve? You can watch that right here. Or check out our video on whether Bitcoin could indeed someday hit $1 million right here. Okay, see you all again soon.